Before we dive in, a quick but important note. I am not a financial advisor, and this presentation is for informational and educational purposes only. The financial products discussed in this video may not be suitable for everyone. You should always consult with a qualified and licensed financial professional before making any decisions about your mortgage or personal finances. Your financial situation is unique, and you deserve advice tailored specifically to you. Alright, let's talk about the money sitting in your bank account right now. Go ahead, picture it. Maybe it's a few $1,000s in your checking account for bills and groceries. Maybe you've got a healthy emergency fund, $10, $20, even $50,000 sitting in a high-yield savings account. You've been responsible. You've done what all the experts tell you to do. You've built a cash cushion for security, for peace of mind, for opportunities. But let me ask you a question that might keep you up at night. What is that money actually doing for you? Right now, your savings are probably earning a little bit of interest, and that's great. But let's be brutally honest. Even in a high-yield account, after taxes and inflation, your cash is likely losing purchasing power every single day. It's lazy money. It's sitting on the sidelines. Meanwhile, across the street in your financial life, you have this giant hungry monster called a mortgage. And that mortgage is costing you 5, 6, 7% interest every single year like clockwork. You have money earning you pennies while you have debt costing you a fortune. It's like trying to fill a bathtub with a teaspoon while the drain is wide open. You're fighting a losing battle, and the banking system is designed to make sure of it. For decades, we've been told this is just the way it is. Keep your savings over here and your mortgage debt way over there. Never shall the two meet. But what if that was a lie? What if there was a way to make your lazy money get off the couch and go to war against your mortgage debt? What if every single dollar you save for an emergency, for a vacation, for your kids' college fund, could be actively working to reduce your mortgage interest every single day without you ever having to spend it or lock it away? Imagine your checking account balance directly lowering the amount of interest you pay on your home loan. That's not a financial fantasy. It's a powerful yet surprisingly simple tool called an offset mortgage. And it has the potential to completely revolutionize how Americans think about homeownership, debt, and building wealth. For millions of homeowners in countries like the United Kingdom and Australia, the offset mortgage isn't some niche product. It's the default, the standard, the obvious choice. And for years, we in the United States have been left out of the conversation. But that's starting to change. This is the financial secret weapon that the big banks hope you never discover. So what is it exactly? Forget everything you think you know about traditional mortgages for a second. An offset mortgage links your mortgage loan directly to your savings and checking accounts. Think of it like this: you have a $400,000 mortgage. At the same time, you have $50,000 in your linked savings and checking accounts. With a normal mortgage, you pay interest on the full $400,000. But with an offset mortgage, the bank looks at your accounts, sees your $50,000 and says, okay, we're only going to charge you interest on the difference. So, you only pay interest on $350,000. That $50,000 in your savings is offsetting a huge chunk of your loan. Here's the magic part, the part that changes everything. Your $50,000 is still your money. It's not a mortgage payment. It's not locked away in some weird account. It's completely liquid. You can use your debit card, write checks, pay bills, and pull out cash just like you always do. If you spend $5,000 on a family vacation, your offset amount simply drops to $45,000 for a while. When you get paid and your direct deposit hits, that offset amount goes right back up. Every single dollar, for every single day it sits in your account, is actively saving you a fortune in mortgage interest. This isn't about making extra payments. This isn't about refinancing to a 15-year loan with a crushing monthly payment. This is about using the cash you already have to work smarter, not harder. The result? You could shave 5, 7, even 10 years off your loan term. We're talking about saving tens of thousands, and for many people, over $100,000 in interest payments over the life of the loan. This is life-changing money. This is the kind of financial efficiency that can accelerate your journey to financial freedom in a way that almost nothing else can. Now I know what you're thinking. This sounds too good to be true. If it's so incredible, why have I never heard of it? Why isn't every bank in America offering this? That is the million-dollar question. And the answer gets to the heart of how the American banking system is structured. It's a system that profits from complexity and from keeping your financial accounts separate and inefficient. A traditional 30-year mortgage is a cash cow for banks. They can project out 360 payments of predictable, profitable interest. An offset mortgage hands a massive amount of that power and that profit back to you, the homeowner. It allows you to pay down your loan on your own terms, using your daily cash flow, and that's a disruptive idea. But while they have been rare, they are not non-existent in the United States. And a new wave of forward-thinking lenders is starting to bring this incredible tool to American homeowners. This video is your guide to getting ahead of the curve. We are going to pull back the curtain on this entire concept. We're going to break down step by step with real numbers how an offset mortgage can save you a staggering amount of money compared to a traditional loan. We'll look at who this is a perfect fit for, like small business owners, freelancers with fluctuating income, or anyone who keeps a significant cash buffer. We'll also be honest about who this isn't for, because it's not a magic bullet for everyone. We'll cover the pros and the cons, the potential fees, and the right questions to ask a lender. And most importantly, we will talk about how you can actually find and secure an offset mortgage for yourself right here in the US. The goal here is to arm you with knowledge that can fundamentally alter your financial trajectory. For generations, we've been taught to see our home loan as a dead weight, a 30-year sentence of payments that we just have to endure. But it doesn't have to be that way. Your mortgage can become a dynamic, flexible tool that integrates with your entire financial life, helping you build equity faster and free up your cash flow for what really matters: investing, traveling, retiring early, living your life. The era of the dumb, static mortgage is coming to an end. It's time to learn about the smart, flexible alternative that puts you back in control. So, how do we take back control? First, you have to understand exactly how the system is designed to keep you from having it. You have to understand the enemy, and the enemy has a name: amortization. It's the dirty little secret of every traditional 30-year mortgage, and it's the reason banks get rich while you stay in debt for decades. Imagine you sign the papers for a $400,000 home loan at a 6.5% interest rate. You're excited. You're a homeowner. That first monthly payment is about $2,528. You pay it feeling proud. You think you've just knocked a good chunk off your loan. But you haven't. Here's the gut punch. Of that first payment, a staggering $2,166 goes straight into the bank's pocket as pure interest. Only $361, a tiny fraction, actually goes toward paying down the money you borrowed. $361. You just gave the bank over $2,500, and your debt only decreased by the price of a fancy dinner. This isn't an accident. It's the design. It's called a front-loaded interest schedule. For the first 10 to 15 years of a 30-year mortgage, the vast majority of your payment is just feeding the interest beast. You're a hamster on a wheel, running as fast as you can, paying thousands every month, but the finish line barely gets any closer. You're building equity at a glacial pace, while the bank is raking in pure profit from you, month after month, year after year. That is the amortization trap. It's a financial prison designed to keep your money flowing in one direction, away from you. Now imagine a different tool, a smarter tool, one that doesn't play by these old rigged rules. This is the offset mortgage. And it doesn't just change the game. It flips the entire board over. The concept is shockingly simple, yet profoundly powerful. An offset mortgage links your mortgage loan to your everyday checking and savings accounts. Think of it like this: you have your mortgage debt in one bucket and all your cash, your checking account, your emergency fund in another. Normally, these two buckets are completely separate. You're paying a high interest rate, say 7%, on the debt bucket, while your cash bucket earns a pathetic 0.1%. The bank is winning this trade by a landslide. An offset mortgage builds a bridge between these two buckets. The money sitting in your checking and savings accounts is now used to offset your mortgage debt. The bank looks at your $400,000 mortgage, then it looks at the $50,000 you have sitting in your linked accounts, and it subtracts one from the other. For the purpose of calculating interest, your loan is now only $350,000. Let me say that again, because this is the core of everything. You still owe $400,000. But you are only paying interest on $350,000. That $50,000 in your checking account just saved you the 7% interest you would have paid on it. And here is the most important part. That $50,000 is still your money. It is 100% liquid. It's not an extra payment. It's not locked away in home equity where you have to beg the bank to borrow it back. It is your cash in your account, available to you 24/7. You need to buy a car? Withdraw it. You have a medical emergency? It's there. You want to invest in an opportunity? The money is yours. But while it's sitting there, every single dollar is working for you, acting as a shield against the crushing force of mortgage interest. This fundamentally changes the nature of your cash. Your checking account is no longer a lazy, passive holding pen for your money, earning basically nothing. It becomes an active, high-powered, interest-destroying machine. Think about the flow of your life. Your paycheck for $5,000 gets direct deposited into your account. With a traditional mortgage, that $5,000 sits there earning pennies, while your giant mortgage debt accrues interest every single day. With an offset mortgage, the moment that paycheck hits, your mortgage balance for interest calculation purposes is instantly $5,000 lower. For the 2 weeks that money sits in your account before you pay your bills, it's actively reducing the interest you owe. The $10,000 you're saving up for property taxes and insurance? It's not sitting in a separate savings account earning nothing. It's in your offset account saving you 7%. The $20,000 you've built up as an emergency fund? It's saving you 7%. The money for your summer vacation, for your kids' braces, for your next car. Every dollar you have, down to the last cent, is working around the clock to reduce the biggest debt you have. This is what financial efficiency looks like. It's making every single one of your dollars perform a job. In the old model, your money is segregated and stupid. Your debt is over here, costing you a fortune. Your cash is over there, earning you nothing. The gap between those two numbers is the bank's profit margin. An offset mortgage closes that gap. It aligns your entire financial world toward a single goal: destroying your debt as fast as humanly possible. And here's the kicker. The money you save on interest? It's effectively a tax-free return. If you have $50,000 in savings and it saves you 7% in mortgage interest, that's $3,500 in your pocket. To get that same benefit from a stock market investment, you'd need to earn a much higher return, maybe 8 or 9%, because you'd have to pay capital gains taxes on your profit. By simply avoiding the payment of interest, you get a guaranteed, risk-free, tax-free return on your cash, equal to your mortgage rate. In a world of volatile markets and economic uncertainty, a guaranteed 7% tax-free return is unheard of. Yet, with an offset mortgage, your own cash can deliver it. So you're not just saving money, you're making your money work smarter. You're using the exact same cash you already have, the same paycheck you already earn, to achieve a radically different outcome. Instead of your payments being devoured by interest for the first decade, that saved interest is now being redirected. It goes straight to paying down your principal. Remember that first payment on the traditional loan, where only $361 went to principal. With an offset in place, that number could be dramatically higher. And a higher principal payment means your loan balance shrinks faster. And as it shrinks faster, you pay even less interest the next month. This creates a snowball effect of debt destruction. The process accelerates. Your mortgage, which was supposed to be a 30-year life sentence, suddenly has a parole date in 15 years or 12 or even 10, all without you having to make a single extra payment or change your spending habits. You just changed the account your money sits in. This sounds incredible, almost too good to be true. So what's the catch? And how does this actually look in a real-life month-to-month scenario? We're about to run the numbers, and the results will shock you. We'll compare a 30-year fixed mortgage side-by-side with an offset mortgage for a typical American family. The difference isn't just a few $1,000s. It's a life-changing amount of wealth. So let's meet our family. We'll call them Mark and Sarah. They're in their late 30s, have 2 kids, and they just bought their dream home in a nice suburb. They're a perfect example of a financially responsible American family. They work hard, they save, and they want to build a secure future. They took out a mortgage for $400,000. It's a standard 30-year fixed-rate loan at 7% interest. Their monthly payment for principal and interest comes out to $2,661. Now Mark and Sarah are good savers. They've managed to build up a solid financial cushion. They have $50,000 sitting in a high-yield savings account that they use as their emergency fund and for future big-ticket items like a new car or a college fund contribution. They're earning, let's say, 4.5% interest on that $50,000. After taxes, that's maybe 3.5%. So they're making about $1,750 a year in interest. Not bad, right? Feels like the smart thing to do. This is path number 1, the traditional way. It's the path that 99% of American homeowners are on. They have their mortgage debt over here and their savings over here, living in 2 completely separate financial worlds. On this path, Mark and Sarah will make their scheduled payment of $2,661 every single month for the next 360 months. That's 30 years. Over that time, they will have paid back the original $400,000 they borrowed. But here's the number that should make you sick to your stomach. They will also have paid a staggering $558,000 in interest alone. Let that sink in. $558,000. That's more than the entire value of the house itself. Their $400,000 home will actually cost them $958,000. This is the brutal reality of long-term amortization. For the first decade of their loan, the vast majority of their monthly payment isn't even touching the principal. It's just feeding the bank's interest machine. Mark and Sarah will be in their late 60s by the time they finally own their home free and clear. That's the standard American dream. But what if there's a better way? Now let's explore path number 2, the offset mortgage. Mark and Sarah get the exact same $400,000 loan at the exact same 7% interest rate. Their required monthly payment is still $2,661. Nothing has changed there. But here is the game-changing difference. Instead of putting their $50,000 in savings into a separate bank account earning a tiny bit of interest, they place it into a linked offset account. This account is tied directly to their mortgage. Now here's the crucial part. They don't earn interest on this $50,000 anymore. I know that sounds like a bad thing, but stick with me. Instead of earning interest, that $50,000 works to cancel out interest on their mortgage. The bank looks at their $400,000 loan, sees the $50,000 in the offset account, and only charges them interest on the difference. So, they are only paying 7% interest on $350,000, not the full $400,000. Think of it like this. Your mortgage is a giant fire, and the interest is the fuel that keeps it burning. Your savings in a regular account are like a tiny squirt gun, trying to earn a few dollars to fight this massive blaze. It's almost useless. But in an offset account, your savings act like a giant fireproof wall. You place that $50,000 wall right up against the fire, and it instantly smothers a huge chunk of it. You're no longer being burned by interest on that $50,000 portion of your loan. So, what does this mean in real numbers for Mark and Sarah? In the very first month on the traditional path, the interest portion of their payment is calculated on the full $400,000. That comes out to $2,333 in interest. Only about $328 of their payment actually went to paying down their loan. It's heartbreaking. But with the offset mortgage in that same first month, the interest is calculated on just $350,000. The interest due is only $2,041. They still make the same full payment of $2,661, but because the interest portion was so much lower, a much larger chunk of that payment, $620, goes directly toward their principal. That's almost double the amount of principal paid down in the very first month. Can you see what's happening here? Every single month, they are taking a bigger bite out of the loan itself. It's like they're starting the race 100 yards ahead of everyone else, and they're running faster the entire time. This effect snowballs. The principal drops faster, which means the next month's interest calculation is on an even smaller balance, which means an even bigger portion of the next payment goes to principal, and the cycle accelerates. So let's fast forward. What's the final result? We ran the numbers through a calculator, and the outcome is absolutely staggering. On the traditional path, remember, they paid $558,000 in interest and it took them the full 30 years. On the offset path, by simply parking their existing $50,000 savings in the offset account, the results are completely transformed. They will pay off their entire mortgage in just 22 years and 3 months. They shave off nearly 8 full years of payments, 8 years of not having a mortgage, 8 years of financial freedom. Think about what that means. They own their home free and clear before their kids even finish college. They can redirect that $2,661 payment every month toward retirement, investments, or travel, all during their peak earning years in their 50s, not their late 60s. But what about the interest? This is the number that changes everything. The total interest they pay over the life of the loan is not $558,000. It's $315,000. That is a total savings of $243,000. $250,000. Gone. Vanished from the bank's pocket and put squarely back into theirs. Let's recap that. By making one single structural change to how they hold their money, Mark and Sarah saved $243,000 and free themselves from debt 8 years early. They didn't have to make a single extra payment. They didn't have to change their budget or cut back on lattes. They simply made their savings work smarter, not harder. They stopped earning a taxable 4.5% on their cash, and instead started saving a guaranteed, tax-free 7% on their debt. It's a straight-up arbitrage on their own money. Now, I know what some of you are thinking. But wait, what if I need that $50,000? What if the roof leaks or I lose my job? In a savings account, it's my money. If I put it in an offset account, is it gone? This is the single most beautiful part of the offset mortgage, and what makes it vastly superior to just making extra principal payments. That $50,000 is still 100% their money. It is completely liquid. If they have a major emergency and need $20,000 tomorrow, they can pull it out of the offset account, no questions asked, no penalties. It's just like a checking or savings account. The only thing that changes is that for the time that money is out of the account, their mortgage balance that's subject to interest goes back up. But as soon as they replenish it, it goes right back to work, reducing their interest again. Compare that to making an extra $50,000 payment directly onto the principal of a traditional loan. Once you make that payment, that money is gone. You can't get it back without refinancing or selling the house. You've lost all your liquidity. You've sacrificed your emergency fund for a slightly lower loan balance. The offset account gives you the best of both worlds. The powerful debt reduction effect of a huge lump sum payment, combined with the total flexibility and safety of a savings account. It is your financial safety net and your debt destruction weapon, all in one. The power that this simple shift provides is something most homeowners never even know is possible. It's a fundamental change in the relationship between you, your money, and your debt. So let's put this into practice. Let's see this fundamental change in action with a real-world example. Meet the Millers. They're a pretty typical American family. They have a $400,000 mortgage on their home at a 6% interest rate. Their monthly principal and interest payment is about $2,400. Now, the Millers are responsible people. They've managed to save up $50,000, which they keep in a high-yield savings account. It's their emergency fund, their safety net for life's unexpected curveballs, a job loss, a medical emergency, a major home repair. And in that high-yield savings account, they're earning, let's be generous, maybe 4.5% interest. Sounds pretty good, right? They're earning interest on their savings. But hold on. While that $50,000 is earning them 4.5%, their $400,000 debt is costing them 6%. Think about it like this: they have two buckets. One bucket has their savings in it, and a tiny faucet is slowly dripping money in. The other, much larger bucket is their mortgage debt, and it has a big gushing hole in the bottom, draining money out at a faster rate. They are simultaneously earning money at a lower rate while paying out money at a higher rate. This is the financial reality for almost every homeowner in America. Your savings and your debt live in two separate universes, and the universe of debt is almost always more powerful. Every single month, the Millers are paying interest on the full $400,000. That 6% interest on $400,000 comes out to $24,000 in interest in the first year alone. Meanwhile, their $50,000 in savings earns them about $2,250. They're fighting a losing battle. Their net position is a significant loss. Now, let's give the Millers a financial superpower. Let's switch their traditional mortgage to an offset mortgage. Nothing else changes. They still have a $400,000 mortgage at 6%. They still have their $50,000 safety net. But now, that $50,000 is sitting in a linked offset account instead of a separate savings account. Here's where the magic happens. The bank doesn't look at their $400,000 loan in isolation anymore. For the purpose of calculating interest, the bank looks at the mortgage balance, and then it subtracts the balance of their offset account. So, the bank's calculation is now $400,000 minus $50,000, which equals $350,000. This is the key. The Millers are now only paying interest on $350,000, not the full $400,000. Let's do the math on that. 6% interest on $350,000 is $21,000 a year. In the old scenario, they were paying $24,000 in interest. By simply changing the type of account their savings sits in, they are now saving $3,000 in interest in the very first year. That's an extra $250 every single month that is no longer going to the bank. Instead, it's going directly towards paying down their principal loan balance. They haven't changed their spending habits. They haven't taken on a side hustle. They just changed the plumbing of their finances. But here's the crucial part, the part that makes this so much better than just taking that $50,000 and making a lump sum payment on the mortgage. That $50,000 is still theirs. It is 100% liquid. It's still their emergency fund. If the roof starts leaking tomorrow and they need $15,000 for a repair, they can take it out. No applications, no penalties, no begging the bank for a home equity loan. It's their cash, available immediately. The moment they take it out, their offset amount drops, and they start paying interest on a higher loan balance again, but only for as long as that money is out. When they put it back, the benefit immediately kicks back in. This completely shatters the old, agonizing decision every saver faces. Should I keep my cash for safety, or should I use it to pay down debt? With an offset mortgage, you do both. Simultaneously, your money is performing two jobs at once. It is acting as your financial shield, protecting you from emergencies, while at the same time acting as your financial sword, actively cutting down your mortgage interest every single day. Let's watch what happens to the Millers over the next couple of years. They continue to make their regular $2,400 mortgage payment. But because their interest charges are lower each month, more of that fixed payment goes toward principal. Their loan balance starts to drop faster than their neighbors, who has the exact same traditional mortgage. On top of that, the Millers are still saving money. Let's say they add another $10,000 to their offset account in year 2. Now they have $60,000 offsetting their mortgage. The amount they pay interest on drops even further. The snowball starts to pick up speed. Every extra dollar they save now has the effective earning power of their 6% mortgage rate, because it's saving them from paying that 6% interest. Where else in America can you get a guaranteed, tax-free, risk-free 6% return on your savings? The answer is nowhere. But with an offset mortgage, that's exactly what you're doing. This creates a powerful psychological shift. Saving money is no longer a passive activity with pitiful returns. It becomes an active, aggressive strategy for wealth creation. The Millers find themselves motivated to save more, to find an extra couple $100s a month to put into that offset account because they can see the direct, immediate impact it has on their biggest debt. They see their loan amortization schedule shrinking. They see years getting shaved off their mortgage. The 30-year slog to freedom doesn't seem so long anymore. Think about the traditional advice. Financial gurus will tell you to make an extra mortgage payment whenever you can. Get a bonus at work? Throw it at the mortgage. Get a tax refund? Throw it at the mortgage. But for most people, that feels terrifying. Feels so permanent. Once you make that extra payment, that money is gone. It's locked away as equity in your house, difficult and expensive to access if you ever need it again. So most people don't do it. The money sits in their checking account, a victim of financial paralysis, earning nothing and offsetting nothing. The offset mortgage removes this paralysis. When the Millers get a $5,000 tax refund, they don't have to make a permanent, scary decision. They just deposit it into their offset account. Immediately, it starts saving them 6% interest. It's working for them from day one. And if 6 months later the car breaks down and they need that $5,000 back, fine. They take it out. No harm, no foul. The friction is gone. The fear is gone. All that's left is a smart, flexible, and incredibly efficient financial engine. This simple example, using just a static savings account, is already life-changing. It can shave years and tens, even hundreds of thousands of dollars off a mortgage. It transforms your emergency fund from a lazy asset into a high-performance debt destruction tool. But what we've just discussed is only the beginning. It's the first gear of what this vehicle can do. We've only talked about putting a lump sum of long-term savings to work. But what if it wasn't just your savings? What if every single dollar that flows through your life, your entire monthly paycheck, every bit of income, could be used to offset your mortgage, even if it's only in your account for a few days before you use it to pay bills? What if your daily cash flow could join the fight? That's when you shift from simply having a smarter mortgage to running your personal finances like a sophisticated business. And that's where this strategy becomes truly revolutionary. The revolutionary part isn't a secret financial product. It's a fundamental shift in perspective. It's about looking at the money that flows through your life, your paycheck, your savings, your bill money, and realizing it's a powerful, underutilized asset. It's time to stop thinking like an employee of your own life and start thinking like the CEO of You, Incorporated. Let's break down the traditional, inefficient model that nearly every American family follows. Think of it as the employee mindset. On payday, your salary lands in a checking account. This account is your temporary holding pen for cash. It's a pit stop. From here, you pay your mortgage, your car payment, your utilities, your credit card bills. Maybe, if there's anything left at the end of the month, you slide a little bit over to a savings account, where it earns a microscopic amount of interest. For the entire month, the bulk of your cash sits idle in that checking account, earning virtually nothing. It's lazy money. Meanwhile, across the street in another department of your financial life, your massive mortgage loan is a relentless machine, working 24/7, compounding interest against you every single day. Your cash is on vacation while your debt is working overtime. It's a completely disconnected system. Your assets and your liabilities live in separate worlds, and you're losing because of it. Now let's look at the CEO mindset. A CEO would never let their company's cash sit around doing nothing. Every single dollar has a job. A CEO would use their cash flow to strategically reduce their largest operational costs and liabilities. In the world of you Incorporated, your biggest liability is your mortgage. So, how do we put our cash flow to work against it? This is where the home equity line of credit, or HELOC, becomes your company's new primary operating account. I know what you're thinking. Wait, you want me to use a line of credit as my checking account? You want me to deposit my entire paycheck into a debt instrument? That sounds terrifying and irresponsible. I get it. It feels counterintuitive because we've been conditioned for decades to keep our debt and our cash as far apart as possible. But stick with me because the logic is simple and mathematically undeniable. Here's how it works in the CEO model. You set up your direct deposit so that your entire paycheck goes directly into your HELOC. The moment that money hits, something incredible happens. Let's say you have a $50,000 balance on your HELOC and your $5,000 paycheck is deposited. Instantly, your principal balance drops to $45,000. For every single day that money sits there, the bank is calculating interest on a balance that is $5,000 lower. You have just used your cash flow to immediately and directly reduce the principal on which your interest is calculated. Your money didn't just get deposited, it got deployed. It went to war against your debt from the second it arrived. Now you still have to live. You have bills to pay. This is where the system gets even smarter. Instead of paying your bills directly from the HELOC with a debit card or check, you put every possible expense, groceries, gas, utilities, subscriptions, on a rewards credit card. Why? You're taking advantage of something the financial world calls the float. When you swipe that credit card, you haven't actually spent your money yet. You've simply created a promise to pay the credit card company in the future. The actual cash remains in your HELOC, keeping your loan balance down and saving you interest every single day. You are effectively getting a 30-day, interest-free loan from Visa or American Express, while your own cash is working for you, reducing your mortgage interest. You're playing the bank's game by their rules and winning. Then, at the end of the month, your credit card bill arrives. Let's say it's $4,000. You make one single payment in full from your HELOC to the credit card company. Yes, your HELOC balance will go back up by $4,000. But for the previous 30 days, you saved interest on that $4,000. And your initial $5,000 paycheck that reduced the balance? Well, after paying the bills, there's still $1,000 of it left in there, permanently reducing the principal balance. That $1,000 is now part of the permanent offset. It's what we call a principal paydown. Let's visualize the difference. In the old employee model, your $5,000 paycheck sits in a checking account earning 0.01% interest. Meanwhile, your $50,000 HELOC balance is accruing interest at, say, 7% for the entire month. You've gained pennies while paying hundreds in interest. It's a losing battle. In the new CEO model, that same $5,000 paycheck is deposited into the HELOC. The balance is now $45,000. For the next 30 days, as you use your credit card, that balance stays low. You are saving 7% interest on that $5,000 for almost the entire month. You're not earning pennies. You're saving significant dollars in interest charges. Then you make the $4,000 payment, and your balance becomes $49,000. You have successfully used your monthly cash flow to not only live your life, but to also permanently pay down your debt by $1,000 and save a substantial amount of interest in the process. Now multiply that effect. Every single paycheck, every bonus, every side hustle income, every tax refund, every dollar that enters your life can be deposited directly into this account. Each deposit acts like a hammer blow to your loan principal, reducing the interest you owe that day, that week, that month. This isn't a one-time trick. It is a dynamic, continuous process of using your active cash flow to suppress your interest charges. Your money is no longer lazy. It's hyperactive, constantly working to reduce your debt. The beauty of this system is its liquidity. This isn't like making an extra mortgage payment that gets locked away until you sell the house. Your HELOC is your checking account. If an emergency happens, the water heater breaks, you have an unexpected medical bill. The money is right there. The available credit is your emergency fund. You don't have to call a broker or sell a stock. You just write a check or make a transfer. You have combined your checking, your savings, your emergency fund, and your debt into one efficient, powerful financial engine. This transforms your relationship with money. You start looking for ways to increase the float. You become meticulous about paying your credit card bill on the last possible day, not the day it arrives, because you know every extra day your cash stays in the HELOC, it's saving you money. You start seeing your entire financial life not as a series of disconnected accounts and bills, but as one integrated cash flow machine that you control. You are the CEO, optimizing your balance sheet, minimizing your interest expense, and maximizing your equity. This is the foundation. And by mastering this cash flow strategy, you're not just paying off your mortgage smarter. You're building a platform for true wealth creation, turning a liability into a launchpad. Now let's bring this to life. Let's talk about a couple. We'll call them Mark and Sarah. They're probably a lot like you. They have good jobs, a couple of kids, and a $300,000 mortgage on a home they love. For years, they did what everyone told them to do. They got a 30-year fixed-rate mortgage, and every single month, like clockwork, they paid their principal and interest. They even tried to pay a little extra, rounding up their payment by $100 or so whenever they could. They were being responsible. They were playing by the rules. But they felt stuck. They felt like they were on a financial hamster wheel. Their mortgage balance was going down, but so slowly. It felt like this giant weight would be on their shoulders for the next 26 years. Their savings account had a decent cushion, maybe $20,000 just sitting there, earning a pathetic 0.0-something% interest, while their mortgage debt was costing them 4 or 5% every single year. The math just didn't feel right. They were losing the game even while following the rules. This is the traditional path. It's safe, it's predictable, and it's fantastically profitable. For the banks, you are separating your assets from your liabilities. You park your cash in a low-yield savings account where the bank pays you pennies, and then they loan that same money back out to someone else for a huge profit. Meanwhile, your largest debt, the mortgage, just sits there month after month, accruing interest on a massive balance. Mark and Sarah realized this. They saw that their hard-earned cash, their emergency fund, their entire financial safety net, was doing absolutely nothing to fight their biggest financial enemy, their mortgage interest. So they decided to change the game. Instead of letting their cash sleep in a savings account, they decided to put it to work. In the United States, the most accessible tool to do this is a home equity line of credit, or a HELOC. Now hold on. I know what you're thinking. Wait, you're telling me to take on more debt? To open a second line of credit against my house? Isn't that risky? That's the first reaction everyone has, because we've been conditioned to think of all debt as bad. But this is about being strategic. It's not about going on a shopping spree. It's about using a simple financial tool to fundamentally change your relationship with your money and your mortgage. Here's exactly what they did step by step. First, they applied for a HELOC. They had good credit and had paid their mortgage on time for years, so they had built up some equity. They were approved for a $75,000 line of credit. This didn't cost them anything up front. It was just an available line of credit like a credit card, but secured by their house and with a much lower interest rate. Step 2, and this is the most important part of the entire strategy. They changed their direct deposits. Instead of their paychecks going into their old, lazy checking account, Mark and Sarah had their entire household income. Let's say it's $8,000 a month after taxes, deposited directly into their new HELOC. Think about what just happened. On payday, $8,000 of cash instantly paid down the principal balance of their HELOC. If the HELOC had a zero balance before, it still has a zero balance. But if they had used it, that deposit immediately reduced what they owed. This is the cash sweep. All of their money, from the moment they earn it, is now sitting against debt, effectively canceling out a portion of that debt's interest calculation. Step 3. They started using the HELOC as their primary checking account. This is the part that blows people's minds. They got a debit card and checks linked to their HELOC. So when they needed to buy groceries, pay the electric bill, fill up the car with gas, or make their big monthly first mortgage payment, they paid for it directly from the HELOC. Let's pause and really understand the genius of this. Their $8,000 of income goes in on the first of the month. The HELOC balance goes down. Throughout the month, they spend, let's say, $6,000 on all their living expenses and their primary mortgage payment. So money flows out. But here's the key. Their money sat in that account, offsetting interest, for as long as humanly possible. The money for the electric bill that's due on the 15th? It sat in the HELOC, reducing their interest owed for 14 days before it was sent out. The money for their big mortgage payment due on the 1st of the next month? It sat there working for them for 30 days. Contrast this with the old way. In the old system, their $8,000 would sit in a checking account earning nothing. They'd pay their bills, and at the end of the month, whatever was left over, maybe $2,000, would be moved to savings. That $2,000 is the only money that survived the month. With the offset strategy, their entire $8,000 income was working for them from day one. Every single dollar for every single day it was in the account was reducing their interest expense. This is the power of maximizing your cash flows, float. You are using your transactional cash, the money that you have to spend anyway, to reduce your debt while it's waiting to be spent. Now for the masterstroke. Remember that $20,000 emergency fund Mark and Sarah had sitting in their savings account? It was their safety net. But it was earning them maybe $50 a year in interest, while their $300,000 mortgage was costing them over $12,000 a year in interest. They were fighting a financial wildfire with a squirt gun. So they made a bold move. They took that entire $20,000 and made a one-time lump sum payment directly from their HELOC onto the principal of their main 30-year mortgage. Boom! Their mortgage balance instantly dropped from $300,000 to $280,000. This is called a chunk down. You might be panicking right now. They just spent their entire emergency fund. What if the car breaks down? What if the roof leaks? This is the beautiful part. They didn't spend it. They repositioned it. By paying it from the HELOC, their HELOC now had a balance of $20,000. But remember, their HELOC has a $75,000 limit. This means they still have $55,000 of available credit they can access instantly anytime for any emergency. Their safety net is actually bigger and more flexible than it was before. Their emergency fund is no longer lazy cash in a bank account. It's active equity in their home that they can tap at a moment's notice. Let's look at the new financial picture. Their primary mortgage is now $20,000 smaller, which means the daily interest calculation is permanently lower. They will save tens of thousands of dollars in years off their loan just from that one move. Second, all of their income is now flowing into the HELOC, paying down that $20,000 balance they just created. With their $8,000 in income and $6,000 in expenses, they are paying down that HELOC balance by $2,000 every single month. In just 10 months, the HELOC will be back at a zero balance. And what do they do then? They do it again. Once the HELOC is paid down, they can take another $20,000 chunk and throw it at the primary mortgage, repeating the process. Instead of chipping away at their mortgage with an extra $100 a month, they are now taking a sledgehammer to it, knocking off huge $20,000 chunks of principal at a time. They've turned their mortgage from a 30-year sentence into a 7 to 10-year project. This is a fundamental paradigm shift. You are transforming your home from a simple place to live into a dynamic financial tool. Your HELOC becomes your command center. It's your checking account, your savings account, and your emergency fund, all rolled into one powerful vehicle that is actively working to destroy your largest debt. You're taking the very same money you already earn and spend, and by simply changing where it flows, you are weaponizing it against bank interest. You are intercepting the wealth that you were previously just handing over to the bank and redirecting it back into your own pocket, back into your own equity. This isn't some magic trick. It's just using the banking system's own rules against them. It's about making your money move with purpose. But this all sounds a little too perfect, doesn't it? If it's this effective, why isn't everyone doing it? Well, there are risks. There are potential pitfalls. A HELOC often has a variable interest rate. What happens if rates skyrocket? What about the discipline required to not treat that line of credit like a piggy bank for vacations and new cars? This strategy requires a mindset shift just as much as a mechanical one. And understanding those risks, knowing how to protect yourself, and deciding if this is truly the right move for your specific situation is absolutely critical before you even think about making a single phone call to a bank. So let's pull back the curtain and talk about the 5 critical risks of an offset mortgage. The fine print that can turn this dream tool into a financial nightmare if you're not prepared. The first and most immediate risk is what I call the rate trap. Lenders aren't charities. They're offering you this incredible flexibility, this powerful mechanism to save thousands in interest, but they often charge a premium for it. In almost every case, the interest rate on an offset mortgage will be slightly higher than the rate on a comparable traditional 30-year fixed mortgage. It might be 0.25%, 0.5%, maybe even more. And your first instinct might be to say, 1/4%? That's nothing. But that's a deceptively dangerous assumption. That tiny percentage difference is the entire battlefield where you either win or lose the offset mortgage game. Think about it this way. Imagine you have a $400,000 mortgage. A traditional loan is offered at 6.5%, but the offset version is at 6.8%. That 0.3% difference doesn't sound like much. But over 30 years, that tiny sliver of a percentage point adds up to an extra $28,000 in interest payments, assuming you paid it off normally. The offset mortgage starts the race from behind. Your mission, should you choose to accept it, is to keep enough cash in your Link savings account for long enough to overcome that initial handicap and then pull ahead. If you can't consistently maintain a significant balance in that offset account, you will end up paying more for your mortgage, not less. You're paying for a feature you aren't using. It's like buying a gym membership with access to a world-class swimming pool, but you never actually go swimming. You're just paying extra for the privilege of knowing the pool is there. You have to do the math, run the numbers for your specific situation, and be brutally honest with yourself about how much cash you can realistically keep parked in that account month after month, year after year. This leads directly to the second, and perhaps the most human risk, the discipline dilemma. An offset mortgage is not a set-it-and-forget-it financial product. It is an active, hands-on tool that demands constant vigilance and unwavering financial discipline. The core feature of the offset, easy access to your cash, is also its greatest psychological weakness. That pile of money, your emergency fund, your savings for a new car, your vacation fund, it's all sitting right there, visible, accessible, and not technically locked away. For someone who struggles with impulse spending, this is like putting a plate of warm cookies in front of someone on a diet and telling them not to touch. The temptation to dip into that fund for non-emergencies can be immense. A weekend getaway seems more plausible. That big screen TV on sale looks more affordable. The mental barrier between savings and spending money gets blurred. With a traditional mortgage and a separate high-yield savings account at a different bank, there's a psychological and logistical friction. You have to log into a different app, initiate a transfer, wait a day or two. That friction gives you time to think, to ask yourself, do I really need this? With an offset account, that friction is gone. The money is just there. It requires a level of self-control that not everyone possesses. You're not just managing a mortgage, you're managing your own psychology. If you don't have a rock-solid budget and the willpower of a saint, you risk eroding the very savings that are supposed to be working for you, turning your interest-saving machine into a personal slush fund that ultimately costs you a fortune. The third risk is the complexity monster. These are not your grandpa's simple home loans. Offset mortgage agreements can be labyrinthine documents filled with unique clauses, conditions, and, of course, fees. You might find account maintenance fees for the Link checking or savings account that you wouldn't have with a standard account. There could be minimum balance requirements, and if you dip below them, you could be hit with a penalty or even a higher interest rate. The way the interest is calculated and displayed on your statement can be confusing. It's not as simple as principal and interest. You'll see calculations based on your daily loan balance minus your daily savings balance. And if you don't understand exactly how to read it, you can't be sure you're getting the full benefit you signed up for. You have to become a financial detective, reading every single line of the agreement, asking pointed questions, and making sure you understand the mechanics of your specific product inside and out. Assuming it just works is a recipe for disaster. Now for a risk that is critically important for anyone in the United States. FDIC insurance limits. We all take comfort in seeing that little member FDIC logo at our bank. It means our deposits are protected by the full faith and credit of the U.S. government. But that protection has a limit. The standard FDIC insurance limit is $250,000 per depositor, per insured bank, for each account ownership category. Now think about the strategy of an offset mortgage. The entire goal is to consolidate as much of your cash as possible into the linked account to maximize your interest savings. For high earners or people who have recently sold a business or received an inheritance, it's not unthinkable to have more than $250,000 in cash. If you and your spouse have a joint account, that limit doubles to $500,000. But what if you have $600,000 you want to use to offset your mortgage? That extra $100,000 sitting in that account would be uninsured. If your bank, the one holding both your mortgage and all your cash, were to fail, that $100,000 could vanish. It's a low probability, high-impact event, but it's a risk you cannot ignore. You are putting a tremendous amount of faith and cash into a single institution, and you need to be acutely aware of where that government-backed safety net ends. This brings us to the fifth and final major risk, the all your eggs in one basket problem. This is about concentration risk. When your mortgage, your checking account, your primary savings, and your emergency fund are all housed at the same financial institution, that bank has immense leverage over your financial life. What happens if you have a dispute with the bank over a fraudulent charge? Or what if their automated security system mistakenly flags your account for suspicious activity and freezes your funds? Suddenly, you can't pay your bills, you can't access your savings, and your mortgage is with the very same people you're now in a dispute with. It creates a potential single point of failure in your entire financial world. Spreading your assets across different institutions provides a layer of protection. It gives you options and reduces the power any single entity has over you. With an offset mortgage, you are willingly giving up some of that diversification in exchange for the interest-saving benefit. It's a calculated trade-off, but you have to acknowledge that you are centralizing your financial life in a way that carries inherent risk. So, you have the rate trap, the discipline dilemma, the complexity monster, the FDIC limits, and the concentration risk. Hearing all of this might feel overwhelming. It might sound like I'm trying to talk you out of an offset mortgage entirely, but that's not the goal. The goal is to arm you with the truth. A power saw is an incredible tool that can build a house, but in the wrong hands, it's incredibly dangerous. The key isn't to fear the tool, it's to respect it. It's about understanding its mechanics, its dangers, and the safety procedures required to use it effectively. These risks are not deal breakers, they are guideposts. They tell you what you need to prepare for, the questions you need to ask, and the systems you need to build to protect yourself. Because only by understanding the anatomy of failure can you architect a plan for success. The question now becomes, are you the right kind of person, in the right financial situation, to navigate these risks and unlock the incredible power of this tool? What does the ideal candidate for an offset mortgage actually look like? Let's break it down by painting a picture of three distinct individuals. Three archetypes. As I describe them, I want you to ask yourself, which one sounds the most like me? Because if you see yourself in one of these portraits, an offset mortgage might not just be a good idea for you, it could be a complete financial game changer. Our first ideal candidate is the disciplined accumulator. Let's call her Diane. Diane is a classic W-2 employee with a stable, predictable income. She's a planner. She has a detailed budget, she contributes to her 401k like clockwork, and she has a knack for consistently saving a portion of every single paycheck. Her savings account isn't just for emergencies. It's a testament to her financial discipline. For years, she's been diligently building up a cash reserve for a rainy day, for future investments, for peace of mind. Now, where does that money usually sit? In a high-yield savings account if she's savvy. And what's that earning her? Maybe 5% in a good year before taxes. It's not bad, but it's not great. Diane's frustration is that her safe money, the reward for all her discipline, feels lazy. It's not working as hard as she does. Enter the offset mortgage. For Diane, the disciplined accumulator, this tool is like a superpower. Every dollar she saves now pulls double duty. Her emergency fund, her vacation fund, her new car fund, all of it gets parked in her linked offset account. Suddenly, that $50,000 she's so proud of isn't just earning a taxable 4%. It's effectively saving her 6, maybe 7% in non-taxable mortgage interest. She's instantly giving herself a guaranteed, tax-free return on her cash that's almost impossible to find anywhere else. The beauty for Diane is the psychology. She doesn't need to change her behavior. Her natural inclination to save and be organized is the very thing that fuels the offset engine. She's not an aggressive risk-taker. She's a methodical wealth builder. The offset mortgage simply provides a more efficient, more powerful vehicle for her existing habits. If you're someone who feels a quiet pride in watching your savings account grow month after month, you might be a Diane. But what if your financial life is the complete opposite of stable and predictable? This brings us to our second archetype, the lumpy income professional. Let's call him Frank. Frank is a freelance consultant, a real estate agent, or a small business owner. His income doesn't arrive in neat bi-weekly installments. It comes in waves. He might close a huge deal in March and deposit a check for $60,000, but then not see another major payday until August. For Frank, a traditional financial system is a nightmare. He has to maintain a massive cash buffer to ride out the dry spells. But that $60,000 sitting in a checking account feels like a lead weight. It's dead money. It's a safety net, but a very inefficient one. When he pays his traditional mortgage every month, He's sending a check to the bank while his own huge cash reserve sits there, earning next to nothing. It's maddening. For Frank, the offset mortgage isn't just a tool. It's a revolution. It transforms his greatest challenge, lumpy income, into his greatest asset. When that $60,000 check comes in, it goes straight into the offset account. Immediately that day, his mortgage principal is effectively reduced by 60 grand. The interest calculation for that month plummets. His cash buffer is no longer just sitting there for safety. It's actively fighting his mortgage debt every single second it's in the account. When he needs to draw $20,000 out to cover expenses during a slow month, he just does it. The loan balance effectively goes back up, but only for as long as the money is out. This structure gives Frank incredible flexibility and efficiency. His working capital is now also his debt reduction tool. He's no longer penalized for his variable income. He's rewarded for his cash management. The offset account becomes the perfect financial hub for his life, absorbing the big checks and smoothing out the troughs, all while minimizing his single biggest expense, his mortgage interest. If your income chart looks more like a mountain range than a flat plane, you could be a Frank. Our third and final candidate is the strategic opportunist. Let's call her Brenda. Brenda might be a seasoned investor or an ambitious entrepreneur. She understands that cash is king, not just for safety but for opportunity. She wants to have a significant amount of liquid capital on hand, ready to deploy at a moment's notice. Maybe it's for a stock market dip she's been waiting for. Maybe it's a chance to buy a competitor's inventory at a steep discount. Maybe it's a down payment on an investment property that just came on the market. Brenda's dilemma is the cost of carry. Keeping $200,000 in cash ready for these opportunities means that money isn't invested in growing. It's the price she pays for being ready to pounce. But with an offset mortgage, that cost of carry evaporates. Her opportunity fund now sits in her offset account, completely liquid and accessible. While it's waiting, it's not idle. It's offsetting her mortgage interest at, let's say, 6.5%. That's a guaranteed risk-free return on her entire cash position. Think about that. She has, in essence, created a supercharged line of credit secured by her own home, but with a crucial difference. She's not paying any interest on it until she actually uses the money. The moment she spots that opportunity, she can wire the money out. No applications, no approval process, no waiting. The funds are hers. And when she's done with that investment, the profits can go right back into the offset account to start reducing her mortgage interest again. It is the ultimate financial staging ground. It provides liquidity, a high-yield return on cash, and debt reduction, all within a single elegant system. Brenda is playing financial chess, and the offset mortgage is her queen, the most powerful piece on the board. If you're someone who constantly scans the horizon for opportunities and values financial agility above all else, you are a Brenda. So who are you? The disciplined accumulator, the lumpy income professional, or the strategic opportunist? You might even be a hybrid of all three. Notice the common thread here. It isn't about being rich. It's about being an active, engaged manager of your money. Diane, Frank, and Brenda all have a clear view of their cash flow. They are hands-on. They see their money not just as something to spend, but as a tool to be optimized. This is not a set-it-and-forget-it strategy for people who want to automate their finances and never think about them again. It's a high-performance vehicle for those who are willing to take the wheel. If you recognized a piece of yourself in any of those profiles, if you felt a spark of excitement thinking about how this could transform your financial life, then your next question is probably, okay, I'm in. What's the exact roadmap? How do I structure my finances, my accounts, and my daily habits to make this system fire on all cylinders? That's the blueprint we're laying out next. All right, let's grab our hard hats and architect this financial machine. The entire system, the entire strategy boils down to a simple, elegant three-account structure. Think of it as your financial command center. You have your offset mortgage loan itself, that's account 1. Account 2 is your linked checking or savings account. This is the offset account, your primary hub of activity. And account 3 is your primary spending tool, a rewards credit card. That's it. The loan, the offset hub, and the credit card. The magic isn't in the accounts themselves, but in how we choreograph the flow of money between them. Let's start with the heart of the operation, the offset account. This is your new financial ground zero. The very first operational step you take is to set up your direct deposit so that every single dollar of your income, your paycheck, any side hustle money, any cash gifts, all of it, flows directly into this one account. No exceptions. We are creating a single massive reservoir of cash. From the moment your paycheck hits, every dollar in that account is working for you 24/7, offsetting your mortgage principal and reducing the interest you owe. If you get paid on the first of the month, that entire paycheck is saving you mortgage interest on the first, the second, the third, and so on. Now, here's where most people get tripped up. Their instinct is to immediately start paying bills out of that account. They see the money come in and they push it right back out. We're going to do the exact opposite. We want to keep the water level in our reservoir as high as possible, for as long as possible. This is where account 3, the credit card, becomes your secret weapon. For the entire month, every single variable expense, groceries, gas, dining out, online shopping, your Netflix subscription, your kids' soccer cleats, everything that can be put on a credit card, is put on that credit card. You are not spending the cash in your offset account. You are using the credit card company's money. Think about what's happening here. You're essentially getting an interest-free loan from the credit card company for 30 to 45 days, depending on your billing cycle. And while their money is being used for your daily life, your actual cash, your entire paycheck, is sitting comfortably in your offset account, saving you mortgage interest every single one of those days. You are leveraging the credit card float, the time between your purchase and when the bill is actually due, to your direct financial advantage. Then, at the very end of the billing cycle, just before the due date, you make one single payment from your offset account to the credit card company to pay the statement balance in full. Let me repeat that because it is the most critical rule of this entire system. You must pay the statement balance in full every single month without fail. Carrying a balance and paying 25% interest on your credit card would instantly wipe out any savings you're making on your 6 or 7% mortgage, and then some. This strategy is for the financially disciplined. It is not an excuse to spend more. It is a tool to optimize the cash you are already spending. By using a rewards card, you're also double-dipping, earning cash back or travel points on your spending, while simultaneously saving thousands on your mortgage interest. Okay, so that covers income and variable expenses. But what about the big, fixed bills that you can't put on a credit card? Your car payment, your student loans, or the mortgage payment itself. For these, you'll set up automatic payments, but you'll schedule them to come out of your offset account on the latest possible date before they are due. Don't pay your car note on the 5th if it's not due until the 15th. Those 10 extra days of your car payment amount sitting in your offset account might only save you a few dollars that month, but over 30 years, those little optimizations compound into a mountain of savings. Every day, every dollar counts. So let's recap the cash flow blueprint. Step 1. All income is direct deposited into your offset account, maximizing its balance from day 1. Step 2. All possible monthly expenses are charged to a rewards credit card, which is paid in full once a month from the offset account. Step 3. All non-card payable bills are auto-paid from the offset account on the latest possible date. This cycle creates a rhythm where your offset account balance stays at its maximum possible level for the maximum number of days each month. It's a simple, powerful, repeatable process. Now, a question I know is bubbling up for many of you is, this is great, but what about my savings? What about my emergency fund? My vacation fund? My new car fund? Do I just lump all of that into one giant confusing pile of money? The answer is both yes and no. Physically, yes. All of your cash should live in this one supercharged offset account. Why would you keep your emergency fund in a high-yield savings account earning you 4.5% interest, on which you have to pay taxes, when you could have it in your offset account saving you 7% on your mortgage, which is a guaranteed tax-free return? It's a mathematical no-brainer. You are giving yourself an automatic raise on the return of your safest, most liquid cash. But psychologically and organizationally, the answer is no. You don't treat it as one big pile. You manage this through what I call virtual bucketing. You use a simple spreadsheet, or a budgeting app like a NAB or Tiller, to track how that single pool of money is allocated. Your spreadsheet might say, total offset balance, $50,000. Then you list your virtual buckets. Emergency fund, $20,000. Property tax sinking fund, $4,000. New roof fund, $6,000. Vacation fund, $3,000. This leaves you with a true checking balance of $17,000 to operate from for the month. The money is all in one place, working in unison to crush your mortgage interest, but your spreadsheet gives you the clarity and control to know exactly what each dollar's job is. You get the maximum financial benefit without the chaos. This system requires a small mindset shift. You stop looking at your bank balance as a simple measure of spending money. Instead, you see it as a powerful tool. The higher that balance, the faster you are paying off your home and building real wealth. It gamifies saving. You'll find yourself looking for ways to keep that balance higher. Maybe you sell something on Facebook Marketplace and deposit the $200. That $200 isn't just $200 anymore. It's an interest-saving soldier working for you indefinitely. The final piece of this blueprint is the regular check-in. This isn't a set-it-and-forget-it system, but it's close. Once a quarter, you sit down for 30 minutes. You review your credit card statements. Are there any subscriptions you can cancel? Any spending categories that are getting out of hand? You review your virtual buckets. Are you on track for your savings goals? You look at your mortgage statement. You see the tangible proof of how much interest you saved and how much extra principal was paid down. This regular review keeps you engaged, motivated, and ensures the system is running at peak efficiency. It's the difference between owning a powerful car and being a skilled driver who knows how to get the most out of it. You now have the complete operational playbook. The 3-account structure, the cash flow choreography, the virtual bucketing for savings, and the quarterly review process. This is the blueprint that turns a simple mortgage into a dynamic financial engine, working to get you out of debt years, even decades sooner. It puts you back in the driver's seat of your single biggest liability. But before you run off to call your lender, we need to have a serious talk. This strategy, as powerful as it is, isn't a magic bullet. It has potential pitfalls, specific risks, and it's not the right fit for everyone. In our final part, we're pulling back the curtain on the potential downsides and asking the most important question of all. Is an offset mortgage right for you? To answer that, we have to be brutally honest. Because on the surface, the offset mortgage sounds like a financial cheat code. A glitch in the system that lets you use the same dollar twice. And whenever something sounds that good, you have to ask, what's the catch? The first and by far the biggest risk isn't on a spreadsheet. It's not in the fine print. It's in the mirror. It's human psychology. An offset mortgage demands a level of financial discipline that most people frankly do not have. Imagine your emergency fund, your kids' college savings, your big tax payment buffer, all sitting in a checking account linked to your mortgage. That money is liquid. It's available. With a few taps on your phone, you can buy a new car, book a last-minute trip to Hawaii, or splurge on that home theater system you've been eyeing. The bank isn't stopping you. There are no guardrails. The system works by treating that money as if it's paying down your mortgage, but it never actually touches the principal. It's always just sitting there whispering temptations. A traditional mortgage creates a forced savings plan. You pay down the principal every month, and that money is locked away in your home equity. It's hard to get to. An offset mortgage is the complete opposite. It's like trying to lose weight while living in a bakery where everything is free. The temptation to just borrow a little from your offset account for a non-emergency can be overwhelming. And every dollar you pull out immediately starts accruing interest on the mortgage side. One or two bad decisions can completely erase years of potential savings. If you are someone who sees a large number in your checking account, and your brain immediately translates that to spending power, an offset mortgage could be a financial disaster waiting to happen. Second, let's talk about the cost. Banks aren't charities. They are in the business of making money from interest. An offset mortgage, by its very design, is built to deny them that interest income. So, how do they compensate? Often through higher interest rates or fees. You might find that the interest rate on an offset mortgage is a quarter, a half, or even a full percentage point higher than a comparable traditional mortgage. You have to do the math. You need a significant and consistent amount of cash in your linked account for the interest savings to overcome that higher rate. If your savings dip too low, you could end up paying more over the life of the loan than you would have with a simple, boring, lower-rate traditional mortgage. It's a numbers game, and you need to be sure the odds are stacked in your favor. The third major downside is something economists call opportunity cost. This is the hidden risk that most people forget to calculate. Every dollar sitting in your savings or checking account offsetting your mortgage is a dollar that is not working for you somewhere else. Let's say your mortgage rate is 6%. By keeping your money in an offset account, you are effectively getting a guaranteed tax-free return of 6% on that cash. That sounds fantastic, and for many people it is. But what if you took that same cash and invested it in a low-cost S&P 500 index fund? Historically, the average annual return of the stock market is around 10%. After capital gains taxes, you might still be well ahead of the 6% you're saving on your mortgage. Over 10, 20, or 30 years, the difference between a 6% return and a 10% return is colossal. It's the difference between a comfortable retirement and a wealthy one. So the question becomes one of philosophy. Are you playing offense or defense with your money? An offset mortgage is a defensive strategy. It's about risk mitigation. It's a guaranteed win, but a small one. Investing in the market is an offensive strategy. It carries more risk, but the potential for reward is significantly higher. There is no single right answer here. For a 55-year-old nearing retirement, the guaranteed 6% return might be the smartest move on the board. For a 25-year-old with a long time horizon, tying up a large amount of cash to save 6% when it could be compounding in the market might be a massive financial mistake. Finally, there's the issue of availability and complexity here in the United States. Offset mortgages are not a standard product at every corner bank. They are a niche offering. This means you'll have to hunt for a lender, and you may have less power to negotiate on terms because there's less competition. The setup can also be more complex, requiring you to understand exactly how the interest is calculated and which accounts can be linked. This isn't your sign here, pay this amount every month kind of loan. It requires active management and a deeper understanding of your own cash flow. So, after all of that, who is an offset mortgage actually for? Who is the ideal candidate? First, the self-employed freelancers and small business owners. This is perhaps the single best use case. These individuals often have to keep huge amounts of cash on hand for quarterly tax payments, unpredictable income cycles, and business expenses. Normally, that money sits in a business checking account earning next to nothing. With an offset mortgage, that cash, which they need to keep liquid anyway, can be working 24/7 to reduce their personal mortgage interest. It turns a necessary evil, holding large cash reserves, into a powerful wealth-building tool. Second, the disciplined, high-cash flow individual. This is someone who naturally saves a lot of money, maintains a large emergency fund far beyond the standard 3 to 6 months, and perhaps receives large annual bonuses. They are risk-averse and don't feel comfortable putting all their excess cash into the stock market. For them, an offset mortgage provides a perfect, safe, and efficient home for their savings, giving them a guaranteed return that crushes any high-yield savings account. And third, the pre-retiree. Someone who has spent decades building a nest egg and is now focused on capital preservation. They are de-risking their portfolio, moving money out of stocks and into cash. An offset mortgage allows them to use that cash to effectively erase their mortgage interest in their final working years, allowing them to enter retirement completely debt-free with their savings still intact and fully accessible. So who should run in the other direction? If you live paycheck to paycheck with little to no savings, this product offers you zero benefit. Its power comes directly from the amount of cash you can park against it. If you are a hyper-aggressive investor who believes every spare dollar should be deployed in the market to seek maximum growth, the opportunity cost of an offset mortgage will likely be too high for you. You'd rather take the market risk for that potential 10% return than the guaranteed 6% savings. And if you value simplicity above all else, if you just want to set up an autopay and not think about your mortgage for 30 years, the complexity and the need for active financial management will be more of a headache than a help. So here's the ultimate truth. An offset mortgage is not a magic wand. It is a sophisticated financial tool. It's a scalpel, not a hammer. In the hands of a skilled surgeon, the disciplined, cash-heavy homeowner, it can perform financial miracles, carving away years of payments and tens of thousands of dollars in interest. But in the wrong hands, it can cause serious damage, creating a false sense of security and a temptation that's too great to resist. The decision of whether an offset mortgage is right for you has less to do with interest rates and more to do with who you are as a person. It's about your discipline, your goals, and your financial philosophy. It's a choice between a guaranteed good outcome and a potentially great one. It's about whether you want your money playing defense, protecting you from the certainty of interest, or playing offense, chasing the possibility of growth. Ultimately, knowledge is the key. Understanding that tools like this even exist puts you ahead of 99% of homeowners. It gives you another option, another path to consider on your journey to financial freedom. And the more options you have, the more control you have over your own destiny.